year, he was my accountant and amazing. And then my husband, Jim Paul, he's a financial advisor with Gate City Advisors. So we make a really great team, number one. But they both are just absolutely incredible at what they do. And what we're talking about today really ties all of this in together. So in deciding what kind of entity you want to be, and then how you can manage your money appropriately to how you manage your money, how you manage your assets, and all of that ties in. So I handed out a little 3-pager on why it's important to incorporate or create some form of protected entity. So out of you all, how many are already set up as a separate business? Not a sole proprietor, but an LLC or a corporation or something. So a lot of you are not. The first thing that I want to go over is why it's important to protect yourself. And what Tom and I were just chatting about a minute ago is the fine line you all have as realtors in working with your clients on a one-on-one basis versus working with them as a separate entity. And what it means in working with them as an individual is that if you have created any type of malpractice, you have your malpractice insurance that hopefully covers us for the things that we need to be covered from if anything arises. But if there's negligence or you've intentionally done something in false advertising or misrepresented property, then if you're not set up as a business and you're working with these clients on a one-on-one basis, then all of your personal assets, meaning potentially your home, your car, your bank accounts, potentially retirement accounts, all of your stuff can be subject to claims of creditors. So as realtors, you all do a lot that puts you in a place of needing or wanting protection. One of the things that pops up to me, so going on your little handout that I gave you, number one, the biggest lawsuits that come up for realtors is misrepresentation. And there are different types of misrepresentation. It could be intentional, that you're just trying to make something look really good, and maybe you've stretched it a little too far, or you haven't gone through all of the due diligence you should in identifying property boundaries or size of homes, things like that. So intentional, what you're looking at is also in your advertising, which goes down to number 4, is your advertising false or misleading in any way. So that's a big area of lawsuits, and probably the one that comes up most often. One of the ones that scares me the most is, I think the last one that I have, number 9, is bodily injury, because my brain starts thinking about, well, if you're driving them in your car, your personal car, to go look at homes, and if you cause an accident where they're injured, and or you cause an accident where someone else in another vehicle is injured, then your malpractice coverage, or E&O, isn't necessarily going to protect you. That would be something to look at with your E&O for sure. But even regular insurance is sometimes not enough. And some of the things that I've seen just come up lately in wrongful death actions where we're handling in the state administration is that with personal injury attorneys involved, they really try to go deep into liability and go after people for punitive damages. And oftentimes those punitive damages, which are pain and suffering, aren't covered by our insurance limits. I talked the last time I was here about the importance of having an umbrella insurance policy, and every one of you should have at least that. So that's kind of above and beyond what your regular auto or home insurance is going to cover, and a little bit beyond the scope of our discussion today, but the types of things that you can do to protect yourself more, those are so inexpensive, would be getting strong insurance and really paying attention to what your limits are. So some of the other types of lawsuits that might come up for agents would be breaching your fiduciary duty, failing to disclose dual agency, that sort of thing, fair housing. This I was just thinking about. I've run into people who are very discriminatory, and you might run into a seller, somebody who says, well, I'm not going to sell to anybody in the LGBTQ population, and you pretty much can't afford that business. You don't want that business when you're dealing with people who can create bigger issues for you in the long run. Environmental things might come up, making sure you have all of your disclosures. And I know you guys are great, and we have super paperwork about the disclosures, but as you well know, clients can be challenging, and they look for any loophole they can to blame something on someone else. And you all are the fall guys on that. And I've seen that firsthand from my years in real estate, that they immediately look to you as the reason they didn't do their own due diligence and didn't know something. And again, we have good disclosures and indemnifications for that, but it doesn't prevent them from going after you. The unauthorized practice of law was one that came up a lot for me over the years, that, and most always, my agents knew that they just needed to get someone else to create any addendums that weren't a fill in the blank. Your fill in the blanks are great, and sometimes you need a little bit more than that. So just making sure you don't do it, because those are the things that come back and bite. And then the Americans with Disabilities Act, I don't know that those are big things that come up. So just thinking about all of the different things that you could potentially be liable for, you want to start thinking about how to best protect yourself. And so what we're here to talk about is taxes mostly, but I wanted to kick this off with why creating a good entity is important. And starting with these liability things is kind of the first step in it. So how do you protect your personal assets? How do you protect your money? Going back to the discussion about the punitive damages, well, let me back up for a minute. So as sole proprietors, for anyone who isn't already an LLC or a corporation, when you get into the issue of damages and recovery, thinking about your home, finances, retirement accounts, all of those things should be protected, but they are not as a sole proprietor outside of what your insurance limits are. When you're incorporated, you start creating a clear delineation between you and your business. Sometimes it's a little fuzzy, and those are things that we just kind of have to talk through, work through, and find as many of those gaps as we can and fill them in, whether it's with insurance or setting up entities. The big question for me in setting things up is what do you want to set up? Do you want to set up an LLC or a corporation? Because it's going to be one of those that you should all do. Technically, you can go online and create that entity yourself on the Secretary of State's website, but as soon as you do that, you're missing pieces. So unless you know what your LLC operating agreement needs to have in it, or if you have partners in it, or if you need to make certain tax selections, you want to know all of those things. So you need a team, you need a good accountant talking with you and deciding if the LLC is the right place for you or if it's a corporation. It's probably leaning more toward corporations these days. Laura could speak more to that for sure. But once you create that entity, now you have to separate yourself from the entity. And that means don't commingle funds. Make sure that all of your payments are going in there, and then you're taking distributions out. that you're not setting up an LLC, but just running everything through your personal account. You can also more clearly delineate what business expenses can safely come out of your business. But creating that entity really shields you, and you should not be a sole proprietor as a realtor. You have too much at risk. LLCs, just briefly, offers pass-through tax treatment of profits and losses. So that just means if you create an LLC, it's a limited liability company, and if you're a single member, you can have it just flow through to your taxes. They're generally a lot more flexible. There are good reasons that we do it. Typically for real estate investors, we'll set up LLCs for the investment properties. You're shielded from personal liability as long as you keep things separate. And that's an area that I see people screw up most often, is that I have my LLC, I did my articles of organization online, I'm good to go. Well, they aren't having all of their agreements done in the name of their LLC or corporation, as the case may be. They're commingling funds and not keeping that clear delineation. Corporations can be C corporations or S corporations, and this handout explains that a little bit. There are a lot of tax advantages to the corporate status. So I guess my takeaway on all of this is, as you're deciding, it's important to work with an attorney to create things so that you know you're not missing any holes in what you need to have done. And don't think about stopping just at the creation of it. Think about, okay, well now, what else in my business do I need to fold into this, and what kind of agreements or paperwork do I need inside the business to keep things adequately protected? But most importantly, before you choose the entity, talk with a CPA so that you know all of the ins and outs for your specific situation, and a lot of things are going to come into play with that. Jim is going to chat just a couple of minutes, and then we're going to turn it over to our tax expert.
Like you see, my name is Jim Hulsh. Which way?
Okay, my what?
What's the chair? My mom sent flowers to his friend who was opening a restaurant, relocation. Bob got there to the grand opening. He was looking for his flowers. His flower that he only had his single night was a white wreath. May the rest in peace. Bob agreed. He calls Forrest says, Bob, we can't do this right now because there's a guy named Barry who has a dozen roses saying, good luck in your new location. Sometimes the product is not bad, it just doesn't fit. And so what we're going to talk about today, we're going to talk about a couple of different requirements. Why we're going to talk about those? Because we're talking taxes. We can save taxes with certain types of requirements. What you've got in front of you, we're going to go through these kind of quick. The first one we have are very basic. So we have, IRS calls them individual retirement arrangements. So in IRS language, it's an arrangement. Normally we call them individual retirement accounts. The traditional versus the Roth. For everyone who works, you're able to set up an IRA, traditional IRA. No problem. It doesn't matter how much income, you can set up an IRA. Most people don't realize a non-compensated spouse can also set up an IRA. So you can shift out $500 if you're under age 50. You can add an additional $1,000 if you're over the age of 50, and that can be saving taxes. Right next to the Roth, the traditional, I say pay me now, pay me later. That's the IRS talking. Pay me now, we pay for the seeds that we put in for the Roth. it grows, we harvest the fruit, income tax free. So we're only paying for the seed, we're being taxed on the seed, it grows for 20 years, 30 years. The harvest that we get, the income we get out of it is never taxed. Not just our investment, but our whole growth. So great benefit if we're younger, especially. Even if we have another 10 years, another 20 years, raw is ideal. The traditional, it lowers our taxes now. So we put in $5,000, we made $50,000. Our actual tax rate is going to be based on $45,000. We're decreasing our amount of taxes down. So that's the big difference between the Roth and IRA. Both good investments. You see $5,500 for contributions plus the $1,000. I have on the bottom there in that section R&D, required minimum distribution. When we get to age 70.5, IRS for a traditional has not gotten any tax. And so, believe it or not, the IRS would like to tax that money. So what they say is you have to pull out some of that money. You start off at 3.6%, we increase every year, and I have a number down there, 19.5%. That's the cumulative that you have to pull out in 5 years. So your investment is going to decrease almost 20% unless you have an increase in your investment. I looked online, Bank of America is paying 1% on their CD, and if you go for a 2-year, it's 1.1% on your CD. So you have to take out that money to pay for the IRS, or the IRS requires you, so your investment's going to shrink if you have an investment in the CD. The 43, that's what percentage you have to take out in 10 years, and it keeps going up. So we really have to, if we want to have it last a long time, we have to make sure to have an investment that's going to be able to increase with as we age, continue to increase with age. Second one I have down there, simple IRA. This is really an employer-employee match. The employer does set it up. We can defer more income. Now, if we're a limited liability corporation, if we're a regular corporation, could we be an employer and an employee? Yes. If we have employees, can we put them underneath here? Yes. The limit maximum deferral for the individual is the $12,500, $3,000 catch up. So if we have more cash to spare, more to invest, we'd be able to add on higher limits under the simple as opposed to the IRA or the Roth. The SEP, one more step up, we can get up to $55,000 deferred. This is an employer contribution only. So it would be, if you're an employer, you could put in this amount of money. You do have to treat employees similarly, percentage-wise. You don't have to comp the same numbers, but you comp the same amount of income. And then it's 25% max. You'll see on that second to the bottom line of this first page, 25% max and up to $55,000. An employee could put in an IRA. So the IRS rules, there's going to be exceptions to some of these as far as maximum compensation, but these are the basic rules that we have on these different types of plans. And that's what we have for different types of IRAs. So you have some easy access, low cost, and you're able to put away some good amounts of money. If you have 30 years before retirement, you can only save $5,000, 7% interest rate, $550,000. That go ways, for retirement. If we go into the simple IRA, we can save $15,500. You can save that for 20 years, $680,000 over a 20-year period. So we can put away some good dollars, and especially when we add in interest, it's going to be a decent amount of money. And that's not maxing out. We're putting in a good amount for our monies. On this back page, 401k, again, employee contributions, $18,000. There is definitely more cost setting up the 401k everything has to be through a compliance, and there is a fair cost, $5,000 a year, $2,000 for small ones. So it is a situation to cover employees, $18,500, and then we have catch-up provisions for the employee. And one extremely nice thing about the 401k, if we want to still work after age 70 and a half, we can still make contributions, and we do not have to take withdrawals. We do not have to take required minimum distributions. So we keep working, we go ahead and make contributions, we still stay active, and we would not have to take those required minimum distributions. And then the one I like a lot, if you do not have employees, the one participant 401k. Again, 18.5 for the employee. You're the employee, you're also the employer, up to 25% compensation, continuing contributions after 7.5. For some people who don't want to stay full-time, a consultant is still an occupation. Right,
That's correct.
We can be a consultant, and we don't have to be paid as much as we do now. We can still have compensation going into 401k. It's for our self-owned benefit. Cost is very low, and you still don't have to pay any required minimum distribution. So those are the two main ones that we look at under the 401k side. I am going to take just a couple minutes. Well, first of all, questions on retirement. We're doing it because of taxes. We want to save taxes. Sometimes we want to save it now with the Roth, we save it later. But the reason we do the retirement plan is to save taxes. We like a nest egg. There's other ways of getting a nest egg, but the retirement plans are going to give us a tax benefit. I also want to get to some basics on the Social Security. There's so few people that really watch this closely. Right now, maximum benefit we can get at our full retirement age. For most of this room, it's going to be 56, 57 years old is when we retire. There's no 65-year-old full retirement anymore. And we can start at 62 with a reduced benefit. So we would lose up to 30%, 32% of our benefit if we start early. Where the compensation is now, where it's set now, but our dollar amount that we get in, we have to have 35 years of earnings before we get to our potential max on there. So if we have a couple years that we took off, if we have a couple years that we're taking care of children, and we only have 30 years of earnings, we would have 5 zeros in those calculations. And so, again, if you work a little bit later, those numbers are going to go up, the number of years of participation, and then that's probably going to drive up your maximum benefit also as you have the additional years. Minimum of 10 years to get a Social Security benefit. There is a spousal benefit available, even if there's a non-working spouse. 50% of the working spouse's benefit. If the spouse is only part-time, we can still get 50% higher. They have 10 years, but they don't have as much, 50% of the other spouse. They can take that 50%, and that's still 100% legal. There is a benefit for divorced spouse. 10 years, but you get the same benefit as you would a spousal benefit, and the different benefits do not take away from the original Social Security beneficiary. So the original person that has the highest benefit, the spouse comes in, it does not take away from their benefit. A divorced spouse comes in, it does not take away from the spouse or from the person that we're still drawing Social Security on. So each entity is by its own, and children and other retired person can have a benefit also. So a person marries late in life, they do have children, and they turn 62, they could get a benefit for the children long term. Still not decreasing theirs, but it would be there's some limitations on that. Widows, last one, widows can start at age 60. So for some people, if a widower is eligible for that, there is a spousal benefit available. They do have that widow's benefit. I'm sorry. If they are married, they would have a widow's benefit if the person who passed was qualified for Social Security. So on all these things, I put my phone number on there. I have a business card with me, but I know we'll do a lot of things. The reason we do it is to save taxes. And that's why we do it. That's it.
Pertaining to the Social Security and a lot of us being sole providers, would you suggest to us to pay into Social Security or just do? Oh, okay. Or just do the Roth IRA versus
Well,
that?
you're not in either or. The Social Security is manual. You know, so we're gonna pay Social Security, and there's a difference. You know, our rate is different from being an employee versus being an employee. You know, so that Laura's going to be. I'm not sure if we're going to get everything into that today, but that would be. We'll figure it out. Any other questions? Ms. Laura Curry.
Hi, I'm Laura Curry. I'm on CPA firm, Curry CPA, and we are located on Longdale Avenue. If you're familiar with Fresh Market or New Garden Nursery, we are right inside there. I just finished my 30th tax season, so I guess I'm a little crazy. But I've been following taxes for 30 years so far. I will say that with the tax law change we just had, that's the biggest tax law change since we've had since Ronald Reagan in 1986, and that was when I was actually first getting into public accounting. So there are a lot of new rules, new laws. We don't have all the answers yet to all of the questions. The IRS is issuing clarifications on the new rules every day. So what we're going to find is we're going to go over some of the changes, but as far as definite answers on certain topics, we may or may not know those answers so far. The best answer to every tax question in America is it depends, because it depends on filing status, there are income thresholds, choice of entity. I think Sue did a really good job talking about the different types of entities, whether to practice as a sole proprietor, an S corp, a C corp, a partnership. One of the things I'll say is that sole proprietors, to kind of get back to your question, sole proprietors are the simplest type to operate as far as from a record keeping and an accounting perspective. However, sole proprietors pay the maximum tax. And the reason that you pay the maximum tax is on your first bottom line dollar of earnings. After your expenses, you're going to pay 15.3% Social Security and Medicare. And that's before you get into your income tax bracket for federal and state. So if you're doing pretty well as a sole proprietor, you could be up to a 45 or 50% effective tax rate pretty quickly. So if there are some sole proprietors in here making some really good dollars, I encourage you to talk to Sue and myself to see if there would be some other options for you that might be better. Now, one of the biggest changes with the tax law affects C corporations. C corporations have been out of favor for years. But what they have done with C corporations is they have dropped the tax rate from 35% as a top tax rate to 21%. That's probably what has really kept the stock market exceptionally high, because all those publicly traded C corporations are now paying tax at 21%. So that's a big savings for them. But that 21% rate also is in effect for smaller C corporations. Now, whether a C corporation is right for you, once again, it comes back to your filing status, your income thresholds, and what benefits you're looking for. But I will say that C corporations are becoming a lot more popular with the tax law change. So just kind of keep that in mind. I will also say that depending on the dollars that you're earning, it has once again become better tax-wise to be a single person. For years, I think back to Ronald Reagan, they tried to equalize out some of those tax benefits of being single versus married filing a joint return. So what's happened, if you are single, you're gonna get up to $500,000 in taxable income before you're in the top tax rate. The top tax rate has dropped from 39.6% down to 37%. So you get $500,000 as a single person, but as a married filing a joint return, you hit the top tax rate of $600,000. So as you can see, if you're doing really, really well, it does favor you at this time to be a single taxpayer. One of the things that's been completely eliminated for this year, for 2018, is personal exemptions. A personal exemption is a tax deduction that's equivalent to $4,050. So if you are a family of four, husband, wife, 2 children, you're now going to lose $16,200 worth of tax deduction when you file your tax return this year. There's been so much talk about the standard deduction that really no one is focusing on the loss of the personal exemptions. So please be aware of that. In the past, they're like, can I claim this? Can I claim that? Personal exemptions are gone. Now, what they have done to try to, compensate slightly for the loss of those personal exemptions is they have changed the child tax credit. So if you have a child that's under 17 years old, the child tax credit has gone from $1,000 up to $2,000. Now keep in mind the difference in a deduction versus a credit. With a deduction, we're reducing taxable income. Now with a tax credit, that's a bigger benefit. With a tax credit, let's say your tax calculation comes out to be $10,000. With a tax credit, you reduce the tax owed dollar for dollar. So they are compensating with a larger child tax credit. Now if your child is 17 or above, let's say they're in school or you're taking care of a parent that you've been able to claim as an exemption in the past, that credit is now $500. There wasn't a credit for that before. So if you're paying college tuition, your tax credit goes from $2,000 down to $500. So there are some real winners and losers in the new tax law changes. Now I do want to go over the automobile rules because I probably get questions about automobiles more than just Dodge and Ford. With automobiles, for purchases effective 1/1/18, the tax code really breaks down the automobiles into 2 different classes. One is if you purchase a vehicle with a gross vehicle weight of 6,000 pounds or more. So if it has 6,000 pounds or more, and you purchase it this year, you can get a $25,000 deduction. It's called a 179 deduction. That's just the code section difference. Plus, you can get an additional $8,000 of bonus depreciation. So if you go out and you buy a gas guzzler, like I did, you've got a $33,000 deduction on your taxes for this year. Now, if you do not buy a vehicle with 6,000 pounds, let's say most vehicles are under 6,000 pounds, except for the bigger SUVs. The deduction this year for that is you can get a $10,000 first year depreciation plus an $8,000 bonus. So this year there is an $18,000 deduction if you buy a vehicle below 6,000 pounds. So that is significant because when you start looking at tax planning at the end of the year, you run your numbers and you're going to owe taxes. Let's say you had a better year than you anticipated and you've been on the fence about whether to buy a vehicle or not. Those increased deductions may help you decide to do that for this year. Now, I want to also point out that all of the things we're talking about today are in the law through the year 2025. And after that, you're gonna have to come up with something new, or it reverts back to the old law. You have a question right there?
Yes, so if you do that and you buy a vehicle this year, you can't count any of your mileage or any of that, correct?
Oh, that's a great question. You're correct. So the way the vehicle rules work is you either take the business percentage of the vehicle depreciation. So those numbers I gave you, where if you have 100% business use. Thank you for asking that question. So it gets reduced down pro rata based on your personal use. So if you had an 80% business use, you would get 80% of that deduction. So you take the business percentage of gas, insurance, repairs, and depreciation, or you take mileage. So if you're buying a new vehicle, typically new or used, but I should say placed in service new for this year, typically you're going to get a much bigger deduction with the actual, the business use percentage of the actual expenses because of the higher write-offs in the first year. Question?
So that's in addition to the 33,000, or no?
Yeah, so if you buy one over 6,000 pounds, you get the business percent of that 33,000 plus the business percent of gas, insurance, repairs, and maintenance.
So you don't get the whole amount, it's how much you use the vehicle. So if you got a vehicle, say you start running your numbers in December, and you're like, oh crap, I need some write-offs, and you run out and you buy a car, and, and I mean, you know we all do this, come on guys, and you run out and you buy a car, you can only use the write-offs percentage for the time that you have the car?
No, it's not prorated by time. So let's say December 25th, you go out and buy yourself a Christmas present.
Right.
And you drive that car 100 miles and it's all business. You get the whole deduction.
It has to be on that vehicle, so what about the vehicle that you used for the other 11.5 months of the year?
Good question. So that will depend on your current method. Are you using mileage on your current method or your percentage of actual? On the old vehicle, if let's say you're using mileage on the old one, you still get all the mileage for the old vehicle. Plus your Christmas present, you can get up to that 33,000 or 18,000 if it's under 6,000. Good question. Yes.
This is an easy one. Back to that under 17, is it 17 and under, or for the?
It's
So if I have a 17-year-old,
$500 credit.
there's 500.
It's 32,000.
But what, if they have gone to school, they're still at home, I still only get $500?
That's correct.
And so it's under 17.
Yes. Yes. So if you're leasing a car, you still go back to the business percentage. So if you're using it 80% for business, your business can deduct 80% of the lease payments. So the 80% of the lease payments, plus 80% of your gas, 80% of your insurance, 80% of your repairs. Or mileage. That's right. It's always you always calculate the higher. And then once you put that method, once you start using that method, you keep that method.
How do you show the percentage that you use it between personal and business?
Basically, you would let your CPA know what your business percentage is, and they would use that in all the tax calculations.
Well, if I said 100%, how can I prove that if I'm audited?
With the mileage loss.
Huh?
With the mileage.
Keep the mileage log.
Right. The mileage log is the best documentation method for vehicles. Any more questions on that? All right, I'll move on. Okay, so let's talk about itemized deductions. Itemized deductions, there are some changes in these rules that as realtors you're probably not going to love. Mortgage debt limits. So before this year, you could sell a home to someone for $1 million, and they could go out and get a loan for that $1 million, and they could deduct all of the interest. Okay, effective 1/1/18, that $1 million has dropped down to $750,000. So, for the majority of your buyers, it's not going to impact them. For some, it definitely will. So that $750,000 debt limit is for home acquisition indebtedness or home improvement indebtedness. So basically, that's for a first home and a second home. So you can't have a $750,000 first home and then a second home and get interest on both. There is a total cap of $750,000. And the other change in this relates to home equity lines of credit. Up before this year, you could have up to a $100,000 line of credit, and we could go out and we could buy that car that we've been talking about, and we could deduct all the interest. It didn't matter what we spent that $100,000 on. Now, home equity line indebtedness is no longer tax deductible at all unless it is actually used to buy or improve your real estate, your residence. So basically what they've done is they've dropped $1 million cap on home acquisition and a $100,000 cap on home equity line. They've dropped all of that down to $750,000, whether it's used to purchase a home or to improve a home. And to me, that has a negative impact on the real estate business for some of your higher end clients. I have a question on that.
The 750 value,
Yes.
whose value are they using to determine that? Are they using the tax, what your property tax for, or?
That's a great question. That debt limit really just comes in for what you're borrowing from the bank. So you can still sell a $2 million home as long as the debt that they have to go to the bank is $750 or less. They can still deduct all of the interest. Okay? All right.
So up to that value of $750, anything under that, you can write off the interest on your mortgage payment and any improvements.
Not improvements, interest on the improvements.
So if you finance the improvements.
Correct. That is correct. That is correct. And of course, this assumes you're itemizing the deductions. But at those limits, you are itemizing your deductions.
So if you were to buy in September, then you're only writing off a couple months of interest.
Correct. That is correct. Any other questions on the interest? All right. Now here's another
Sherry up there smiles.
Well, it's complicated. I mean, these new rules are complicated. Here's another area that does not help the real estate industry either. There is now a cap on taxes. Okay, so let me explain what falls under this cap. Typically, when you itemize your deductions, we are adding up all of our North Carolina income tax paid. So that could be in the form of W-2 state withholding. It could be if you're a sole proprietor, you add up all of your state estimated tax payments. It could be the taxes from the prior year that you pay in the current year. So if you owe state income tax on your 2017 return, when you file in 2018, that is now a 2018 state tax deduction. Okay, is everybody with me on the state taxes? From W-2s, from estimated tax payments, and from tax payments paid for the prior year. Just the state, not federal. Okay, federal taxes are never tax deductible. So we're just talking state. Then you take all those and you add real estate taxes on your first and second home. And then you add up your property taxes on all your vehicles. Okay? You add all three of those things up, and that is now capped at $10,000. That is a significant reduction in taxes. Significant. So, if you owed $5,000 in your state taxes last year, and you've got a $2,000 real estate tax deduction, and you make estimates, and then you add your car taxes, more than likely you're going to hit that cap, and it's all gone. All of that is gone. You just do not get a deduction for any amount exceeding 10,000.
So estimated 10% not.
Yes.
So you shouldn't buy yourself that Christmas present.
Actually, you do want to buy yourself a Christmas present.
Okay.
Because here's why you want to buy that car. Here's why you want to buy that Christmas present. If you're a sole proprietor, you're getting that deduction right there on your Schedule C, or in your S corporation, or in your LLC, or in your partnership. Okay, it's not an itemized deduction. Itemized deductions are personal deductions that do not affect your business. Okay, so if you have a sole proprietorship, you still get that deduction. If you have a rental property, okay, and you've got the Schedule E, you've got your rental income, you've got your mortgage interest, you've got your real estate tax on that rental property, you still get all of that because that is still under the umbrella of the business. We're talking about first and second homes when we're talking about itemized deductions in the cap.
You have to have the LLC in order to do that.
But you can still be a sole proprietorship. As a sole proprietorship, you can still deduct that car. Okay? The business use, once again, the business use is the depreciation of the car.
So your estimated payment on your business.
Now, your estimated tax payment on your business, good question, that still falls under the itemized deductions. So if you have a sole proprietor, you have an S corp, and you're making estimated tax payments, that still falls under this limitation that we're talking about. So it's painful limitation.
So do you advise people to, I guess you can say, give up an item so they can stay within that bracket so they keep the credit?
Which credit?
I'm talking about the $10,000 cap.
Okay. The thing is, a lot of times we don't have a choice in paying those taxes. You know, we need to make our state estimated tax payments, or we're going to get penalized. We have to pay our real estate tax. We have to pay our auto property tax. So unfortunately, there's not a lot of planning opportunities around that unless you're going to toggle back and forth between an itemized deduction and a standard deduction. Okay, so here's the way all the deductions work. You know, you add up your medical above that threshold, the taxes, the interest, the donations. And if you exceed the threshold for the standard deduction, you itemize. If you don't, you get the freebie, which is the standard deduction. So for some people with the new rules, it might be beneficial to pay 2 years worth of real estate taxes in 1 year to itemize, as long as you still fall below that $10,000 cap. Does that make sense? But there's just not a lot of planning around that $10,000 cap that we don't get to. Okay? Another thing that's gone are miscellaneous itemized deductions. Okay, so the miscellaneous itemized deductions affect, let's say you're a W-2 employee or your spouse is a W-2 employee, and they have unreimbursed business expenses, or mileage, or an office and home. Those deductions are totally gone. Now, you can still get an office and home if you're a sole proprietor on your Schedule C. So it's still available unless you are a W-2 employee and it falls under the miscellaneous itemized deduction. I know this is very complicated. I'm trying not to lose too many of you. This stuff is very, very complicated. One piece of news that's good falls under donations. Okay? So, you can still give all your money away. With donations, the deduction cap has gone from 50% to 60% of your income. So in this example, if you have $100,000 of taxable income, you can give away $60,000 and get that full $60,000 deduction if you want to. Now, I want to touch on one of Jim's points. Jim talked about the RMD, required minimum distribution. The reason I want to make this point is with the state income taxes being shaved down, it's possible more people will claim the standard deduction. Okay? With that in mind, if you have a standard deduction, the standard deduction amounts for this year, for 2018, are if you're a married felony joint return, it's $24,000. Okay? If you're a single taxpayer, it's $12,000. And if you're head of household, it's $18,000. So that's the freebie amount. So what that really means is, as far as donations, is if you're taking the standard deduction, you're not getting a tax benefit for a donation. Does that make sense? Because you either add up all your itemized deductions, including donations, or your standard deduction. So if you take a standard, you get no tax benefit from a donation. Unless, this is a plain point Jen can help you with, unless you have an RMD, required minimum distribution. In cases where you have RMDs, if you make an RMD directly to a charity, you still get the donation, even if you take a standard. So that's a planning point that you can consider to talk to Jim about. If you guys aren't taking RMDs, you may have parents having to take RMDs.
So then we can be set it in half to do that though, right?
Yes.
To get their primary, and then funds certain.
That's why I said some parents.
Yeah.
Yeah, there may be some, you may have some parents 7.5 having to take out RMDs. So that is something to keep in mind. Another thing that can impact you guys is if you work with any relocation teams and they've got moving expenses. The deduction for moving expenses is gone. So my concern is that with moving expenses gone, and the real estate cap at $10,000, and the mortgage interest deduction coming down, it could have an impact on buying and selling homes. You kind of combine all of those things together. As we all know, millennials like to rent. There may be more and more people renting, moving in the future, as far as in the future goes, because of some of these caps. So I just want to make sure that you are aware of kind of everything that's going on there.
I see it. So I guess I'm trying to figure out how to word it. So your S-corp, or let's just say your company itself, is it better to just use like a payroll system or QuickBooks or something to that extent to assist you with
Documentation, keeping a documentation?
Yes.
That's a good question.
Your
Yes.
structure and everything?
I think it really depends on your strengths with IT. QuickBooks is a great program if you understand how to use it. But if you don't, it can cost more accounting fees to fix your QuickBooks than if you had just kept a manual ledger.
Okay.
So I'm a big believer in what is the best way for you to understand the information you give me. I have clients that do manual. I have clients that do an Excel spreadsheet, and they add everything up by category on an Excel spreadsheet. I have clients who give me stuff in QuickBooks. I have clients who give me stuff in QuickBooks. So it really depends on what works best for you. From an accounting perspective, we can work with all types of records. Okay? Yes?
You may or may not have been on this, I'm trying to write, but the capital gains taxes, gain on selling, didn't that change too? As far as, isn't it single, you can process up to 250,000 and then married, isn't it 500?
Okay, that rule did not change, but let me clarify for you. If someone is selling their principal residence, as long as it's been their principal residence for at least 2 out of the last 5 years, if you are married filing a joint return, you can exclude a gain of up to $500,000. If you're single, up to $250,000. Now keep in mind, that's the gain. That's not the sales price. Just the gain. Now, one thing you may have heard, there are some changes in the rules related to like-kind exchanges. There are no more like-kind exchanges except for real estate like-kind exchanges. So that may have been what you heard about the change. So, in old law, you could do a like-kind exchange with your vehicle and defer paying tax. Now you can't do that. But the 1031 rules related to real estate are largely unchanged.
What if you're selling a non-primary residence? So like, or people who are selling rental properties or something like that, and they want to roll that money back over to avoid the tax and the capital gain on that. How many days? Is it 45?
To identify the property, and 180 days to file the replacement property. So with a rental property, you can still, because that's not a principal residence, you can still do the lifetime exchanges to defer gain. It's just the principal residence rules for gain exclusion and the rental property rules for gain exclusion are very different. Okay? And if you sell a second home, and you make a profit on it, you will pay tax on the gain on the second home. It's not your principal residence, so there's no gain exclusion.
You're at a meeting with realtors, or to make it, like, if you make 100,000, we only have to claim 80,000, we get a 20%. Does that tend to do what that means?
Yes, in fact, I'm granted because that was the next thing I was going to cover. Okay, so the point that you brought up is the most complicated part of the new tax law. In fact, last Tuesday, I went to an 8-hour class just on this one tax deduction. And it is awful. It's a calculator. The rule on this new deduction, in simplified terms, if you have a profit or your income is $315,000 or less, taxable income, you can get potentially a 20% deduction from your income if you are a sole proprietor, S corp, LLC, or partnership. So let's say you've got rental income. You've got rental income minus deductions, and you have a bottom line profit of $10,000 from that rental property. There is a potential $2,000 deduction available. But I say potential because clearly with an 8-hour class, there's a lot of roadblocks in this calculation. Depends on your profession, what you do. They generally, if you're a personal service business, you have limitations. You, as realtors, don't qualify under that personal service rule, so you would still be able to get that deduction even if your income was over the $315,000. But the rule is it's based on income, wages, and your profession as to whether you actually get that deduction or not. It can be a tremendous savings if you can jump through all of the hoops. And there was a big joke at the tax seminar about we just have all the software and figure it out because it's so damn complicated. But you are correct. If you have $100,000, you do potentially have a $20,000 deduction. But don't put it in your pocket until everything is calculated on all the different items.
But after your business expenses and everything is calculated out of your income?
So in this example, let's say you had $150,000 of revenue, $50,000 worth of business expenses, so that your profit from that business is $100,000. Whether it's a sole proprietor, S corp, LLC, or partnership. When it flows into your personal return with a $100,000 profit, you have a potential $20,000 deduction. If it's a $10,000 profit, you have a potential $2,000 deduction. Does that make sense? It's a big one.
But the potential word that you use. What does that just?
The reason I say potential, the IRS is supposed to release 3 publications this year clarifying how this deduction is calculated. At this point, they've only released 1 of the 3. And that first one created an 8-hour class. There's 2 more to come. So that's why you can't really just flat out guarantee it, because there's too many exceptions. That's why I use the word.
Do we still deduct our accounting service?
You can if you're a business. If it's under a business, you can. But if it's, if it's an itemized deduction, if it's not under a business, because miscellaneous itemized deductions are gone, accounting deductions are gone, legal deductions are gone, the real fiduciary fee deductions are gone. The financial planning fees you pay, deduction is gone. One thing that may give you guys some good news is if you don't have health insurance, the shared responsibility of Obamacare penalty is repealed effective next year. So there will no longer be a penalty tax on the Obamacare shared responsibility payments. All right, let's talk about one more thing because I know we're running out of time. Entertainment and business deals. Okay, this is a big one. And in the past, we lumped all meals and entertainment together in one category, and you would get a 50% tax reduction. And the way I kind of thought about that in my mind was, if I take a client out to eat, and we talk business, I can deduct their meal, but I can't deduct my own. That's kind of the way I've always thought about it. Effective this year, entertainment expenses are totally gone. So if you take a client out on the golf course, gone. If you take a client to a basketball game, gone. Anything is, if you take a client to the country club and it's entertainment, it's gone. Okay. Now meals, for the most part, we think most meals are still going to be tax deductible unless the meals are associated with an entertainment function. So if the meal is associated with an entertainment deduction, we may lose that. And the reason I say may, we're waiting on IRS clarification on that point. But if it's just a straight out, hey, let me take you out to lunch to talk about this property, you're still going to get 50%. Travel expenses, you still get 100% of travel. Travel is untouched.
So what are they gonna do in lieu of?
I'm sorry,
What
what?
is that 20% you just told us about?
So that's what they're doing.
That potential 20%, that's big, guys.
Yeah, it is huge.
It is big. I mean, it sounds like it's all going away, but that's a big deal.
It is a big deal.
So do you think it's better or worse in the personal opinion?
I think it depends. I think it depends on income, filing status, profession, how many kids you have, the ages of your children.
So let me go back to the entertainment thing.
Yes.
If one of the guys does a client appreciation party and they rent out a movie theater, everybody comes in with their kids and gets to watch the movie, no deduction for that.
That is a good question. We don't have clarification on that yet.
Okay.
So because
Are they eating? No, I'm just kidding.
the entertainment portion wouldn't be,
Well,
but there is a possibility.
Is can you call it marketing? It's not that. Can it?
If you can call it marketing, if you can justify marketing, you can claim any deduction if you're willing to take the risk. So marketing is still tax deductible.
And it's a referral,
A lot of times when we want to do gifts, business gifts have a $25 limitation. It's supposed to be deductible only the first $25. But if you put your name and contact information on it, it's then advertising or marketing, and then it's a full 100% tax deduction. So not to not answer your question, but we don't know yet.
Okay.
That's one where the entertainment and the meal aspect are so intertwined, we're just not sure.
So if we host an open house for a client that's just moved in, they invite all their friends, and we spend $200 on food for it, are we able to take half that food?
I am inclined to say yes, but because all of that is now a gray area, except for a straight out, take someone out to just eat, I can't answer that with certainty. But I feel like until they come up with clarification, I would take it. If they come up with clarification 2 years from now that says you can't, then we don't. Any other questions?
From a real estate agent's perspective and from an accounting, which is better for them to do, form an LLC or an S corp?
It depends. The reason, once again, it depends. As a sole proprietor, it's the simplest way to go. You pay the maximum tax, and you're in the highest risk of being audited. And unfortunately, that goes back to a lot of hairdressers and painters that did not report all of their cash receipts, and so self-employed people get audited more than businesses do. Now, whether you should be an LLC or an S corp or a C corp, it depends a lot on the total family income, what deductions you're looking for, and what income range that you fall in. I'm like Sue. I don't like sole proprietors. I think a sole proprietor pays too much tax. I think the unlimited liability scares me. People will sue for anything all the time. So I think it's really important to run a business incorporated in some fashion, whether it's an LLC or an S corp or a C corp. With S corporations, in that example about your sole proprietor, when we were talking about the 15.3% Social Security and Medicare. Okay, so with an S corporation files tax returns. There is a reporting requirement, but an S corporation does not pay income tax. Okay, it files the return, and whatever the bottom line profit is, that drops into your personal income tax bucket. So if you're married, it's going to drop into the bucket with your spouse's income. Okay, but what happens is all of those bottom line earnings that drop into your personal bucket, they are not subject to Social Security and Medicare. So if you have a $100,000 profit as a sole proprietor, that's $15,300 Social Security and Medicare. As an S corp, if you have $100,000 that comes in, that's zero of Social Security and Medicare.
You still have that percentage, so don't make the salary.
That's exactly right. So what's happened is people were doing that for years, and the IRS said, wait a minute, guys, we're not getting any Social Security and Medicare. So what came out of that is the IRS says you kind of have to determine a reasonable salary for yourself to take out of your S corp. Now, depending on what your profit is and your earnings and how good your CPA is about arguing on your behalf, reasonable might be $12,000, it might be $24,000, it might be $60,000. Depending on what you're making, it might be $100,000. There used to be kind of a rule of thumb that said, let's make sure your wages are at least about half of your S corp income, but even that is being shattered. So I don't know what the rule of thumb really is, but 50% has kind of always been in the past. So let's go back to that example of $100,000 worth of profit in an S corp. If you took a W-2 out for $50,000, okay, you're going to still pay that 15.3% on $50,000. But the other $50,000, you're not. So you're looking at about a $7,600 savings in Social Security and Medicare by setting up that S corp. But as far as the answer, it depends. Let's also think about how old are you? When you look at retirement planning, how close are you to retiring? Do you want to pay in more Social Security because you're getting closer to drawing? Or are you really young and you don't have a lot of faith in the system? And you don't want to pay in as much Social Security. So how much Social Security you want to pay in also affects this decision of, do I want to be in this corporation? Do I want to stay a sole proprietor? Do I want to look at LLC? For clients that have rental property, if you've got a client buying a rental property, if they're not putting it in an LLC, they are doing themselves a large disservice. Rental assets are the highest assets to get sued. So if you have a client or you yourself are buying a rental property, you need to put it into the LLC when it's originally purchased, if the debt is in the name of the LLC as well. Because if if you have the debt in your personal name and then want to move it into an LLC, you got to refinance the loan. So it's a lot better if you just put the initial property in the LLCs, and Sue can help you with that. Now, if you've got a property that's paid off, a rental property that's paid off, then you can very easily move it into an LLC for liability protection. Yes?
What about second home?
Second home. Okay, so with a second home, if you're just using it yourself, you're not going to sue yourself. So I don't see a lot of second homes going into LLCs. Okay. Now, if you've got a second home and it is a beach property and you're renting it, well, then it's really no longer a second home. It's now a business where you are renting it out and you want to put that in an LLC.
These are fantastic questions, and I think it all just drives home the importance of Ken's answers. We are all so different, our circumstances are all so different, and that's why it's important to have a really good team from the get-go. Laura has been mine for a number of years, and there are so many things that come up for me that I'm just baffled by, and I know that I can just turn to her and she does that, what she does, and makes it all work. And it gives me such a sense of security and comfort to know that she's got my back, and she's constantly looking. Some of you had asked about payroll stuff earlier. They can even help with that. And she's, I'm turning a lot of my own over to them now. I've been doing it on my own through my bank, and there were some things that came up through some of these tax changes that I didn't know about that really impacted my taxes, and we had to redo some things. So I just said, take it all. But she's amazing, and I just wanted to throw that in, that it's worth taking the time to create your team and figure all of these pieces out. I talked about in my estate planning thing that we do free consults. Primarily for estate planning, but I want you to know too that you can pick up the phone and call me or call Jim and ask questions and kind of sort through things, or email even. But we're a great team.
And I need to go back to one question, because now that I'm thinking about it, I'm not sure of my answer. The child tax credit, when you were asking what about 17, I actually probably didn't check that. Because I was thinking it was under 17, but it might be 17 and under qualify for the $2,000 credit. So let me hedge my answer on that and check that. Thank you. You're welcome.
So the first step in incorporating, if they're thinking about it, they need to meet with you.
Meet with me, or meet with Sue, or meet with Rick.
Okay. And then it's determined, and you'll handle all the legal part of it.
Correct, yeah, and I think the both of us is a good idea, and a lot of times that's what I do is, we'll start the conversation, but then I'll say, well, you need to talk to your accountant. It's a whole lot easier if you just start with us.
Absolutely. Now, who here loves tax law as much as I do? Because there are always openings in public accounting. We are always looking for good accountants.
So are we.
That's right.
Oh my goodness. So if you're ready to hop out of real estate, public accounting is a great industry. We're always going to have lots of jobs, because all this tax simplification is up to about 3,000 pages of internal revenue code. So that postcard return, if you can read 3,000 pages, you can get a postcard return. That's never going to happen. Anyway, thank you for coming to hear the three of us speak today. I tried to help this part of everyone, but if someone didn't get my card, please let me know. We've all been doing this a long time, and we're very good at what we do, and we love the business. So thank you, guys.
Thank you. We appreciate it.